Investors want to be able to understand it, pull it apart, and obviously explain to their stakeholders what they're investing in.
Hello and welcome. My name is Brian Caplen, editor of The Banker. This is a masterclass with Lloyds Bank of the UK, which is looking at funding solutions for a new era. I'm here with Matthew Cooke, who is Managing Director, ABS Capital Markets, and in this first chapter, we're discussing the role of securitisation. So Matthew, securitisation had a bit of a bad time during the financial crisis, but clearly it's starting to recover. So, I mean, what's different about it now, from the crisis to now?
I think the main difference is that we're seeing structures that are far more simple, so they can be understood by a wider range of investors. I think the problem in the past was that everything was a little bit different, and the industry needed a more vanilla solution around the funding product. I think the main difference in the last probably 12 to 24 months is a lot more support or sponsorship from central banks and regulators globally that the securitisation has a purpose to place in the funding
because
market.
the regulator had a bit of a dam on it, didn't they? I mean, it was regarded as one of the causes of the crisis, and now perhaps the regulators are starting to see that there really is some funding opportunities this way.
Absolutely, it was tainted. I mean, the industry in 2003 to 2007 went through dramatic growth, and there was a lot of excess around structures and participants in the market. But I think it's being seen now from the regulators and central banks. It's a very pure and efficient tool to push capital down into sectors such as mortgage lending or SME markets.
Okay, so what are the typical sectors where we're finding growth in securitisation at the moment?
I mean, the mortgage market or mortgage-backed securitisations, I'd say it's almost back to a proper full recovery, and that market is functioning quite well. So we're seeing good volumes of RMBS in the markets. Unsecured personal loans, credit cards, auto finance is a very active component in the market. And we're starting to see the emergence of SMEs in the ABS space.
All right, because that really does get on the political agenda, doesn't it? So, I mean, all governments want to really fund SME lending, but it's quite complicated to do SME lending by securitisation, isn't it? So,
it is. Not all SME lending is homogenous, and homogenous instruments fit well into an ABS program. So what we're trying to focus on is assets such as equipment leasing that sit on bank balance sheets or non-bank balance sheets that we can simply and efficiently put into a securitisation program. Traditional SME lending can have revolving lines of credit, which are very problematic to try and work in an efficient way for securitisation.
Okay, and now, I mean, banks are looking at securitisation as sort of one of several options these days, right?
That's right.
Which is a little bit different from the crisis. So explain that to me.
It was. I mean, what we saw in the lead up to the crisis was business models that were on both ends of the spectrum. Those that use deposit funding purely and those that use a lot of securitisation funding. Now, wholesale markets seized up, and those that used a lot of wholesale funding hit problems. We're now seeing treasurers of banks and also non-bank lenders basically saying we need a broad mix of funding tools and we need a very long-term sustainable funding model. So we're seeing the right mix of deposit funding, whether that's retail or corporate deposits, senior unsecured, covered bonds, and then securitisation.
Because in many European countries, not the UK, but I mean, covered bonds were considered the prime way of doing these things, especially funding mortgages. Okay. So has that changed?
I think the balance is starting to shift. I mean, covered bonds have been around for hundreds of years in Germany and parts of Scandinavia and so forth. In the UK, it's a relatively new instrument. But I think covered bonds versus securitisations, they all have their own pros and cons. Asset encumbrance is a big characteristic that regulators, even equity investors, are focusing on in terms of how much assets you encumber for your funding programs. I think securitisation is probably a better mix of asset liability management on your balance sheet than a pure covered bond. But again, everything needs to be in the right mix and perspective.
Okay, and finally, I mean, what's their take on securitisation and these new structures that are coming forward?
The new structures are far more simpler structures. So I think what we find is there's often a pressure for innovation, but continually we're hearing from the investor base, and this is globally, that keep it simple. Investors want to be able to understand it, pull it apart, and obviously explain to their stakeholders what they're investing in. Obviously, credit quality is imperative, And alignment of interests, like the skin in the game treatment that came in post-crisis, is a very important characteristic in securitisations.
Okay, and that's where the bank has keeps a piece of the securitisation, so that their interests are aligned. That's
correct. So the sponsor or the originator of the assets must keep 5% in or around the securitisation program.
Okay, yep. We'll come back and talk about the new approaches to funding in just a minute.